So 23 was a very interesting year, and today we are in the middle of a market where pretty much the entire world agrees that India is a place to be. So that's no longer the question. But when you are in the middle of certain markets like this, where there is a lot of optimism, maybe some call it euphoria, some call it for the right reasons, because there are strong earnings growth backing this. It's also important to understand the path that got us here not very long ago, but just 12 months back, right? If you just look back on the notable events in 2023, it was very significant. When we started the year, in fact, in December 22, I had written a note to all our clients saying that this is going to be a great year for positioning and there is going to be volatility. Many people forget that the first quarter of calendar year 23 was volatile. There were announcements from the US where a bank called the Silicon Valley Bank filed for closure. In fact, if you combine all the state banks of the US that actually had required the FDIC line for it to come back, just to put it into perspective, the total dollar value of FDIC protection this year was 3 times the total dollar value of protection in 2008. Right? Just to put it into context, when Washington Mutual filed for bankruptcy in 2008, the FDIC line that the Fed tapped was roughly around $175 billion. In the first 5 months of 2023, the FDIC line that the Fed tapped was close to $545 billion. So this was not a very easy year in terms of digesting headlines either, though it doesn't look like that's how we are ending December 23. The VC market had slowed down, rightly so, because 2021, there was quite a lot of excesses from the flow of money. Inflation had hit a 10-year high as well. All 10-year rates saw one of its highest levels that we've seen in the last 5 years. And today, things are a lot more calmer. Back then, if I had said anything around the markets, nobody would have said that this is how we would end these markets. While there is a lot of interesting views on India, India was not the best performing market in calendar year 23. Quite the contrary, there were both US, there was Brazil, LATAM, Russia, multiple countries, including DAX, that have done really well. What is though standing out as far as India is concerned is from a consistency perspective over the last 3 years, we've seen very strong returns and we've seen much lower volatility than usual, which is what is attracting foreign capital into the country, because there was always an excess risk premium placed on our country, primarily because of 2 factors, us being an emerging market country and second, for currency depreciation. And both of that, for the first time, I think FIIs are willing to take that risk from a perspective of stable earnings growth as well as stable policy at the top. Now, breaking down at a very top-down level, where did India's returns come from? I just broke down to you saying that 3 years, our markets gave a cumulative 55% return. Now, the returns that one generates is the combination of earnings growth of your companies as well as the PE re-rating that the market gives you. Now, what we as analysts look for is companies that have the ability to grow earnings. And when you position yourself well, through a combination of sentiment, flows, and liquidity, there is a chance and a probability of a PE re-rating. PE re-rating cannot be quantified. It is given to you by the market, and that's where the element of positioning comes. So if you break down the years of growth of India, your earnings growth in the last 3 years is 57.5%. As a result of which, there has not been any alpha from a PE re-rating perspective yet, as far as India is concerned. And that is what is interesting around why India can be viewed as neither too cheap nor expensive. Right? So there are pockets. And here, when I say market, I'm purely referring to a Nifty 50. I'm not going down the market cap curve here. I'm only taking the top 50 companies and doing this analysis. Now, where did US returns come from, though? why is US also doing so well when at a time the Fed's balance sheet is actually come down? So if you look at this chart, 2008, if we were at X in terms of money printing in the US, 2020 took us to 3.5 times X, and 2021 took us to 4.5 times X. Versus that 4.5, we have come down a bit. So the Fed has actually delevered its balance sheet a bit, not significantly. We've not reached 2020 levels. We have to get there somewhere because the balance sheet has to delever, or Fed might take a call that they keep money printing and they keep inflating their way out of debt, which means inflation is structural, not transitory. And that's something that we'll have to see. And I have my own views on it, which I will discuss later. What's important to understand is while people keep talking about liquidity coming into the system, enough and more dry powder, all of this dry powder is actually going into money market funds, right? So this chart below shows you the actual volume of money market funds that is in the system, which is roughly around $6 trillion today. It used to be closer to pre-COVID, $3 trillion. So what has happened, and that makes sense because as the interest rate goes up, instead of, if your equity yields in the US, which is currently 3.4 to 3.5%, is more suboptimal than investing in money market funds, which gave you roughly around 4.5 to 5.5% early part of 2023. So many people look at this and say this is dry powder for equities. I would like to slightly differ from that argument. I don't think this is dry powder for equities because this money is actually invested from a yield basis, not from an equities perspective. So it's important to understand that while balance sheet has expanded, it's not necessary that all of this has to come into equities, which is one of the arguments that many economists make, saying that this is the dry powder in the system. Now, it's also important to understand another market when sentiment is not in your favor, what happens. See, it's really interesting that China's returns over the same period is negative 34%. When I say China, I'm talking about a similar equivalent of Nifty 50 for China, which is the Shanghai Composite Index. Now, it's not that Chinese companies are not showing growth. That's a misnomer. And that is what is actually wrong, because Chinese companies over the last 3 years at a CAGR basis has actually grown at around 6.5 to 7%, which is in line with their GDP growth, right? So 23% cumulative growth. But what has caused a significant drawdown and there is a sentiment change is a PED rating. And that is what the market gives you. That's something that you cannot price in. So the market does look cheap. And for people to realize that valuations are cheap, this is predominantly what is happening within China. So just because you buy growth and just because you buy it at a sensible valuation does not mean you will make money. Those are the ingredients to make money. That is not a guaranteed as long as your sentiment has to be there. And that is an important factor because for the last 2 decades, our sentiment flip-flopped. For the first time, our sentiment seems to be on track. With this as the background around what has happened in calendar year 23, we'll just break down ITIS's own performance. We've had a reasonably good year this year, beating the Nifty by slightly over 4.5%. This puts our cumulative return since inception at 271% against 167% against Nifty. As many of you are aware, we run a multi-cap fund. So one of the things that I try and do, not on a quarterly basis, but more so on an annual basis, is to try and explain to investors why do we benchmark to Nifty 50. And I wrote this in 2017, and I continue to believe that this is what you will see in the next cycle of growth of India as well. In the next 5-7 years, it is going to be very hard to beat Nifty. Nifty will not only be your best performing index, it will also be your lowest volatility index. And our aim of a fund, while it is easier to compare it with Nifty 500, is to beat Nifty 50. And one of the aspects of how we've always structured the fund is to ensure We manage liquidity and we don't manage returns. What that means is we have risk caps on how we think about small caps, how we think about liquidity, and how we think about transitioning risk across market caps, which I'll explain in due course of the slide.